Hello folks, welcome back to Arrival, part two. In this video, we're going to take a look at the management team, the financials, the outlook and catalyst for the next year or so, or 2 years in this case, and then our final thoughts. So the management team, we've got Dennis Sverdlov, who is the CEO. He's an ex-telecoms founder of a 1.5 billion corporation, and he actually has a number of Russian political roles in his past, which is pretty interesting. And then we've got Avinash Arugaba to his right. He is the president, previously head of strategy at Motors Cruise from September 2017 to January 2019. For those that aren't aware, General Motors Cruise were an automated car organization. So it's great to see somebody at the innovative end of the automotive industry coming on board with the rival, which, of course, from a production perspective, you can't get more innovative than. Then we've got John Wozniak, who's the CFO. He actually was with Motorola for a number of years and served them as they were that legacy provider into that transition to the profitable and agile 8 billion Motorola Solutions business that we see today. That operates in 100 plus countries to 100,000 customers. And he'll be a great addition because he's got that big business global feel. And then we've got Michael Elberson. He's the CEO of the US enterprise or operations, I should say. He had 35 years with General Motors in a number of positions. This one's an interesting one. He was the vice president of EV infrastructure and also the vice president of global strategy and innovation from September 2015 to October 2018. So great to see somebody from a traditional provider making that leap over into Arrival's world. And he'll have no doubt have an understanding on that production element and in which, if Arrival can achieve these goals, how successful they could be. And now to the board of directors, we've got Peter Shuno, unsure if that's correct. So this guy served as the chairman of the board at Iconics Brand Group. They're on the Nasdaq exchange under the ticker Icon. They're a brand management company. They own a number of global consumer brands. What's actually interesting, though, to me, is that this guy was the first president of Marvel, and he oversaw the 4 billion sale to Disney at the end of 2009. That's pretty cool. I like that from a storytelling perspective and branding, of course. And then we've got Yun Song Hao. I hope I've absolutely nailed that. It sounded great, but I'm sure in the comments you'll tell me if I've butchered it. So he's been a director since July 2021. It's worth probably noting here. So this chap is the vice president and head of open innovation and investment group for Hyundai Motor Corp. Of course, Hyundai and Kia pumped 100 million into this business back in 2020. And I'm sure, I don't know this for a fact, but I'm sure Yun Sung Hao has been pushed onto that board to strengthen such relations. I don't really have a clear understanding of the mechanics of that deal, other than that they were working on joint automotive vehicles. And then we've got Miss O'Hara to finish it off. So she's been with the company since March 2021. So she's currently the senior vice president of Hearst Magazines. She served, interestingly, I don't know if this is a typo, but for a month as VP Business Solutions of Snapchat. And also she served as the chief marketing officer for global media for Time Warner, which again is a huge one, right? You can see from, I guess, a few of the heads that we've got on here, the importance of brand image and positioning in the world. And I think that's going to be really important for these guys over the next 5 to 10 years. There's a few others I haven't mentioned, but their focus is more on the investment side. So VC specialists, which I think might come in handy later down the line. But if you actually look at the way that this company is owned, I believe 70 to 75% is privately owned by a VC. And with the amount of shares outstanding they have, I can only assume that, there is that element of will they raise or will they not flood, but dilute just on the basis of needing cash, which we can cover off in the next section. I think the management team is pretty solid, by the way. Nothing massively exciting, but it's solid. I think the focus on marketing and image, and I think the branding of the business today is nothing short of sensational. Okay, so financials for 2021 Q3. So $26 million loss, which is to be expected compared to a loss for the period of the same quarter last year of 22 million. 47 million in expenses. Now, this is the interesting one because admin expenses of 38 million and R&D expenses of 9 million make up that 47 million figure. But that's when you compare it with last year, this for the same quarter, we had admin expenses of 20 million, so they've almost doubled, and non-capitalized R&D expenses of 1 million, which have gone up by a factor of 9. Now, look, that's to be expected. We are pre-production, of course. There's going to be things that they have to innovate on, of which they would stick under that banner. So capital expenditure of 81 million for this quarter compared to 21 million in the third quarter of 2020. You could put that down to the ramp up of production in the multiple sites in both the US and the UK. Equally, we obviously have the site in India and the new site, newish, not new, but the sites in Russia as well. And I think that feeds into that last point there on the fact that the employee figures have doubled from the quarter of last year to this year. Luckily, on hand, or say luckily, we've got cash equivalents of 381 million as of September the 30th, and hopefully they can keep a handle on that or get in some early revenue for the next year. Equally, it's worth noting that they do have an approximate figure of each microfactory in the future being worth around 50 or cost around $50 million. Okay, so outlook and catalysts. First things first, we do have some mounting costs that we need to cover off. There's an industry-wide expectation. There's going to be an increase in expected costs of raw materials, including aluminium and petrochemicals. Now, what they've done here at Arrival to try and de-risk the start of production and enable Arrival to scale is they've incurred additional costs today to hopefully save them tomorrow. What these costs are is they've decided to assemble battery modules and bring logistics in-house, which is adding to CapEx and OpEx. Interesting proposition because, for one, do they have the capability to perform and deliver on it? I don't know the answer to that. And what is going to be the upskilling and training elements that feed into this? How easy is this to achieve? I don't know. So it's an unknown for me. Secondly, they're starting to deliver prepayments to LG Energy Systems to secure battery cell line capacity for the next several years. Love this. You know, they don't want that gap in their supply chain. And I can understand that's exactly why they're looking to bring the assembly of battery modules and logistics in-house also, as well as, you know, getting those raw materials in play as well. So it's not necessarily a negative. And then, of course, higher selling, general, and administrative expenses as Arrival scales their sales. Now, that's to be expected, to be perfectly honest. They also expect higher working capital in its first factories to ensure the company has the necessary components, which, look, the first few factories, they're going to go over budget. It's just as simple as that until they really nail down the processes. You know, it's just going to be a part of life with Arrival for sure. But it's worth taking note of the slow ramp up. Okay, so you've got the bus and van production volumes expected in 2022 to be pretty modest, and that's because it's the first year the company is starting production, and it's now actually expecting an even more conservative ramp up than it first thought. They expect to start each microfactory on one shift rather than two. They don't expect to reach full capacity until early 2023. Furthermore, due to capital constraints, Arrival has moved its fourth microfactory to 2023, so even slower there. And I guess the revenue is expected to be seen in the second half of this year, but more so the fourth quarter. And these expectations are dependent upon the successful completion of vehicle certification. Okay, so that's an interesting point there and something to be aware of. Improved efficiencies, of course, which they're looking to achieve, which they noted in the previous segments, of course, around, I guess, dropping that capex cost. They want to deliver on 50 million. They plan to continue to lower the OpEx requirements in its microfactories, and they expect that long term production and assembly of the OpEx to be reduced to approximately 15 million per microfactory, which is interesting. Initial operating cost for logistics is currently around 10 million per microfactory. However, the company expects to optimize this as it scales the number of microfactories, and they expect to reduce that cost drastically over time. Of course, at this point, it isn't clear cut. They can't give us figures on what they're looking to reach, but there's that understanding of, look, what they're doing is innovative. There's going to be higher costs associated in the early days, which is, I think, entirely expected. And then we've got to the bottom line right, further customers and pre-orders, right? They've got lots of trials running at the moment. It's about making some of those a success. And I think if they can bring a few of those on, it's gonna really, I guess, ramp up interest in the stock more than anything at this time, because revenues aren't going to be seen for 6, 12, 18 months. It's about actually closing those proof of concepts, and I guess having those proof points in the market more than anything. And then of course we've got the EU sites. So Madrid was delayed, but I think once that they get the first microfactories on board, that EU focus may well shift again, and they can bring in some more EU focused orders. Okay, so finally, what are the thoughts here about the information that we have delivered today? So, the microfactory approach is nothing short of revolutionary. Okay, you're enabling lightweight entry into geographies, bolstering local communities, and being close to multinational prospective customers are huge bonus ticks. We've got the US and the UK is the initial focus with their production lines, which makes sense. You do have that delay with Madrid, which kind of feels a little shaky to me, just simply because you have EU regulations and how well they're geared to be, I guess, that global leader. And they have those cut-offs with 2035, and it's all around sort of delivering as many, I think it was 75% of EVs by 2030. So they have figures there to back up I guess, the need to invest, right? That said, you've got the UK trials, and that multi site approach there is elite. I think they're going to absolutely dominate in the UK. Remember, 1 in 6 cars will plug in 2021, so I believe right time, right place for arrival. But they can't really afford any further delays. I think any further delays, it's going to really kick shareholders in the gonads, but hopefully they can push that on. The management, I think, is pretty steady. Financials are okay. I think, by the way, there's an extract from the earnings that's worth covering off. So this is it. We do things that have never been done before, and we expect our powerful technologies will change the fundamentals of the automotive industry. With that comes the unknown. So I think what they're basically saying there, it's a precursor for further delays. I think without a shadow of a doubt, if they overcome these challenges, you're looking at, with ease, the global leader of the EV sector, with ease. There's no question in my mind. But I think where they are today, and with the risks that are coming up, and even the types of wording that the organization are using in their earnings, I don't believe that if you're, well, I only believe you should buy the stock if you're willing to hold for an 18 months minimum. This is not a short timer at all. They need time to upscale production, get the US, UK online. They need to finalize, I guess, actual deals and the trials that they've currently got running, which is really important. And then they also need to look at that cost reduction piece. So there's a lot to be done here. But then that said, you've got around a 4.55 billion valuation today, and then they've got 1 billion in letters of intent in value, right? So they're in a bloody comfortable position. However, it is a waiting game with this stock. Certainly a hold. I think if you own the stock today, don't sell it. My God, albeit it's a long one in my opinion. I think you're going to be waiting at least 9 months until you see an upturn, and any further delays over the next 6 months with that Q4 production note is going to be a concern. Well, for the share price anyway. Maybe not for the business long term though. Look, I know that this has been quite long session, so I do appreciate if you've listened to both part A and part B. I really hope it's added some value. As always, if you want to see my notes, my actual research write-ups, then you can follow me on Twitter and drop me a DM, and I'll share that, no problem at all. And again, if there's any critiques or advice that you guys have got for me and how I present and where we're at, particularly with this stock, then yeah, hit me up and drop it in the comments. But thanks again for listening.